Hello guys, glad to have you on board again today. Quick warning as usual, this is experience level podcast, so if you are anything close to a beginner or whatever, lacking of experience, please stand by. Anyway, let's focus on the essential. I hope you guys are experienced, or at least getting close to it. Today's topic is we're gonna do a technical review of stuffs. Obviously, NFP is down the corner, so there's nothing we can deal with in the short term rather than dealing with volatility. So those of you who are experienced enough and want to go down this road, then generally know how to deal with that. A second option, your portfolio is already orientated, either bullish or bearish, and you're just going to wait for the catalyst to show up, and we'll have a risk management to make out of here anyway. So for the bears, the timing has already been done, so normally you're already secured, which means you shouldn't be risking any fucking thing with whatever could happen out of the following days. For the bulls, then you have very few signals and a very low level of risk management prior to this NFP. So you can still try to get in thanks to Trump, who somehow gave you an opportunity to get safely in yesterday. The problem is it really feels different to me this time. I'll explain later on. I could be totally biased once again. I totally stand on this, all right? I have a bearish vision, though I don't really give a shit about whatever could be bullish. It's just risk management to me. So the question is, how much do I risk manage depending on what I can see? So still a lot of subjectivity in here, as you know. Trump administration still trying to save the dip each and every time for very shadow blurry reasons. All right, we know that some of the officials are also trading for their personal accounts, which is, I mean, collusion some way. It shouldn't be happening, but anyway, so they're manipulating the market for their own trade or their friends' trade. So it feels like, all right, be ready to buy. I'm tweeting in 2 minutes. All right, so oh my god, I just can't stand it. But anyway, very interesting timing, because obviously yesterday when the market bears were somehow losing strength is exactly the moment chosen to just send a tweet. I mean, they're not even trying to build a story right now. They're just tweeting the key words. It's absolutely, I mean, it really is amazing to me to see how stupid that is right now, because it's the same old shit, spit it out at the same old timings. And right now they don't even nearly care about hiding the stuff. I mean, it's in plain sight. Like right now, you can imagine the next tweet is going to be China talk. Like, they're not going to say anything more than that. These are just the core keywords that algorithms are seeking forward for. So yesterday was U.S.-China trade talk, China trade talk coming next week. I mean, that's crazy fucking short sentence. So it's just, it feels like the administration is directly talking to algorithms. So anyway, I would say clap, because once again, it's been working at least so far. But the problem is we still have those shadows in the background in which the macroeconomics are really one more time going a little bit more into shaded gray areas. We're not still dark, all right? Don't get me wrong. We still don't have dark numbers, but some numbers are dark. Some numbers are still a little bit brighter, though we've got something in between. We're shadow gray area. The thing is, we've solved none of the previous problems. Remember, the early 2018 was about CPI, so about inflation. We were disappointed by the fact that the inflation was low as corporate profitability was high. So what the fuck was happening? Now we know what the problem is, and it's freakingly simple. Why don't we have inflation, core inflation, as corporate profitability has significantly improved? Simply because when they make more money, instead of paying of rising paycheck, they do rise dividends, they do rise share buybacks, they do rise cash amounts to pay for debt. So what the companies are doing with that excessive amount of cash is just deleveraging the debt, so paying for previous debt, rising dividends, and share buybacking. All right, that's what they do. All right, so, and on top of this, when they have a little bit of excessive margins, what they do is that they lower the price to just bid on take tiny bites out of their competitors, all right? So we've got a cheaper price battle in here. When you can make money, you sell things cheaper, so you basically eating your own competitors. So it's more like market shares being taken over the competitors. So this thing leads to one very dangerous thing, which is monopolistic visions. And I strongly stand on this. You should really, really have a look at how these things ended in history when we had monopolistics. Monopolies and huge wealth concentration in Great Britain back in the old days. All right, so let's just learn your fucking history. So if you think these things are going to keep on going into a dystopian vision of the world in which the rich will get even richer, they'll control the world and stuff like that, I would say yes, learn the fucking history and you'll figure out that at some point this doesn't last endlessly. Anyway, that's just one point. The thing is in here anyway, so CPI core hasn't been working as effectively so far and it still hasn't recovered. So we were fearing low inflation back in those days, it still hasn't recovered, all right? So first thing, the old problems are not solved anymore, all right? We were hoping for Pyongyang to stop sending missiles. They're still sending missiles. So we haven't been figuring out a damn problem so far, right? The Trump administration has been creating shit tons of problems. They'll be trying to deal with them, but they managed not to make a single one of them working so far. So we're piling up the shits, and either the shit will somehow solve all by itself, or the problem is we're going to have to pay for all of it at once. That's what I fear, and when I say fear, I don't nearly fear anything. It's just what I think, all right? I wouldn't be using that word, because fear is generally a very bad, when you're fearing something or whatever, generally means, nah, you're biased. So I'm not fearing, I just think that's normal. But anyway, so that was CPI core. Then later in 2018, the problem was corporate profitability doubts, like some earnings release were showing some signs of disappointment. We were fearing, though, that the growth will dampen sharply. That's what exactly happened. I mean, we slashed growth from half. We were back a year ago. We were expecting 4% growth. We're now barely expecting 2 and 2.3%. So, yes. And has this problem been solved in between? Absolutely fucking not. All right. So now what's the next problem? We've got PMIs and production data showing some huge slowdown. Basically what that says is that we can't expect growth to pick up tomorrow. We've got very, very important slowdowns that will take quarters to actually figure out. So now we know that the growth is not going to recover tomorrow. It's going to take a little while. Now we're fearing about services to drop as well, which will have an even more significant impact on how long it will take to recover. That doesn't mean we can't recover and that the recession is inevitable. I think the recession, if it shows up, can be very limited, like a very tiny recession. All right, like I don't expect the market to fall for years and stuff like that, unless we get some political problems on top of that. But that's a story I'm going to keep for later in this video as well. So growth problem still not solved. Now we're fearing that it's going to, we fear of contagion from manufacturing to services, because if it happens, then inevitably we're going to have a recession. That doesn't mean a big, awful recession, but just a short-term recession, something that lasts for at least a quarter or two, probably no more than that. And the third final problem, the final fear, and like I said, that is the last big rock that hasn't been falling so far, is the job market. So this is the last thing Wall Street is holding on to. Like, we've got a strong job market, so people are at work, and as they work, they don't fear the worst, all right? They can still pay for their checks, and as long as they work, they don't think. That's exactly what we're holding on to right now. That's fine, but as usual, things cannot last forever. And as we are probably topping up on the job market, means we can just expect for worsening. And that's the big problem right now, because we're expecting these things to show up, and if they do, then we'll have to face it, which means all the core elements of an economy are showing signs of worsening. So how can we rise asset prices on that conclusion? That's the problem we're having right now. We can't rise because of very bad data and very bad geopolitical context, and we're just bracing for the best. The problem is, if we figure out the best can come for at least a couple years, then how can we stay there? The market can't stay there long enough. We can't range forever in just a 5% wide range. So the problem is that we've been building some very dangerous positions, either on the VIX or on asset prices, which means things must be good. If they are not, or if they're shadow gray, we're gonna have to dampen prices. And that's the huge problem we're having right now. So we need to figure out what the hell happens with the job market. Reason why this NFP is more than anything else the most expected thing right now. Because if we do see somehow worsening conditions in the job market, the market will start fearing that people will get to lose part of their jobs. And moreover, they'll start losing their job on the worst economical areas, which means the manufacturing sectors. Manufacturing is not the thing that happened in the big cities where the money is and where the wealth is concentrated. These manufacturing sectors are countryside, poor people that are just already mostly in debt. So if those people are in debt, and if they get to lose their jobs, most of these people have been working all their lives into the same sector. So it's hard to convert them to another services sector all right? These guys cannot be immediately switched to service jobs. They will have, there's inertia with those guys. As they get fired, they can't find jobs because the manufacturing sector is under huge pressure right now and can be even more in the future. So less jobs on the worst, on the most dangerous class in the American people, which means the poorest people getting to lose their jobs, so probably not being able to pay for their rent, not being able to pay for their credits, and that is the worst case scenario. Like I told you, there is even darker scenarios I don't even talk about because those guys are like end of the world guys, all right? So I don't really go down this road. I think these things are the worst case scenario among the possible scenarios, all right? So if these guys start to lose their jobs, start paying their paychecks, rising the credit default, more than anything else, this will probably pop the credit bubble. That's simple as that, all right? And if you think that's too black for a vision, too dark, then no way. It really happened a lot in the past, so I'm not inventing things. This is how it works, all right? If you've got credit and people not paying for credit, then this is always the same people who actually trigger the crises. Who's been targeted in 2008? Who's been triggering the credit crunch? Do you really think that's the smart guys in Wall Street who's been triggering the bubble to pop? No, it's definitely the poorest ones who weren't able to pay for their fucking shit. This is what triggered the credit crunches. So I've been talking to you about the credit problems in the US for a little while, all right? These problems are there. That doesn't mean they will obviously trigger. All I'm saying is that if they trigger, they'll trigger because of the poorest people in the US. And those guys are definitely linked to the manufacturing sector. This is why the manufacturing sector is important. But the services contagion is what could just light up light up the fire. And that's the problem, right? Because the thing is that I think there's a problem with the manufacturing sector. It could trigger the credit bubble, but there's another side problem, which is this contagion in which instead of just popping the credit bubble, we get to recess the economy. Because for now, services can somehow compensate for the manufacturing drawdown. That's fine, right? That means we're probably not going to recession because of services holding on. But if services falls, that's another problem. Not the credit problem, but the recession productivity problem, the GDP fucking problem. Which means if services falls down as well, just like they do in Europe, if US is following the same path, then where are you going to get your growth from? This is the problem, right? Growth is what drives asset prices to the upside. If growth is negative, growth can't be negative actually, but yeah, if you get contraction in the economy, all right? I mean, GDP can't be negative, right? That's what you need to understand. That's it, all right? So the thing is that if we get down this road, how do you deal with that? How do you deal with that? You can't sustain asset prices the way they are right now. So this is risk. You need to understand and see the market just like that. This is how much risk are you willing to take to buy the shit right now? Do you really think that risk worth the price you're paying and the expectations for higher profitability in the future you might be hoping for? I don't think it's worth it. So in a global mid-term to long-term perspective, job market is the only thing that holds us to the nearby area. If the job market shows signs of worsening, we're probably going to lose grounds out of this area. So today is an important number. So that means this number will obviously trigger a market fall or whatever. No, if the market is just showing some signs of slowdown, but not a catastrophic kind of slowdown, then we probably have to price that in, but doesn't necessarily mean we have to drop 10%. What could be significantly bad is that if you take out the numbers that have been shown and released over the course of the last week, they're all pretty fucking bad, like 20%, not 20%, but they're significantly lower than what the market was anticipating, which was actually not even good at all. So the market was anticipating lower numbers, and the market actually released even lower number, and not just a bit, significantly lower numbers. So if we get to be far disappointed in the NFP today, then yes, losing grounds could be a possibility. So you must be ready for it. Just like I said, be ready for the worst to show up, but don't necessarily expect it either, because both are dangerous. Right? If it goes down, it's normal, because we weren't supposed to go that high for so stupid reasons in the past. Right? The Trump's manipulations and stuff like that. We have to pay for those shits. So if we go down, we're going to pay this for we're going to pay extended amount of losses because of this. But still, that's it, all right? And we need bad numbers to fuck that up, all right? These numbers are the reality. I told you Wall Street will fall when the reality will catch up on us. The problem is this really reality? You don't know yet. All you can tell is that the slowdown's definitely there. It probably will last more than people expect it to be. But is this necessarily going to lead to a possible recession? You don't know that now. You don't know it. All you can know right now is that bad NFP will have consequences on both of the bad scenarios, because job market going down can put pressure on the lowest and the poorest classes in the US. It can also put pressure on employers, all right, which means some part of the economy will still keep on hiring, but if some people start to drop off, then that will create tension. All right, the fear to lose the job, which means when people start to do it, the first thing they generally do is stop spending or reducing their spending, just because they expect and brace for the worst. So they keep on spending because they have to. It's just they spend less. And when they do this, consumption significantly starts to drop, which means GDP goes as well. So that's the big problem, all right? The job market plays on the three danger areas of Wall Street. Credit crunch problem because of the lowest and the poorest being put it on pressure if job market starts to fall, because not to fall, but starts to reverse, because these are the first ones that generally are the targeted one. So credit problem could be increasing because of job market worsening, job market conditions worsening. It could also trigger growth to even dampen further, all right? And it could also, like we said, oh fuck, I just forgot about the last one. Damn it. Anyway, let's move on. So no, let's go Forex, all right? Though the problem is, I'll still stand that to me the dollar is pretty fucking much overvalued. For a simple reason, because obviously there is the safe ground, the usual safe ground. When shit hits the world, as most of the world debt is in dollar, what people do is that they safe hold the money in dollars. So that's the usual stuff, right? At some point, dollar is generally considered as being one of the safe haven assets, like gold and stuff like that. So people have been running for dollar recently, especially into emerging countries in which the shit has been hitting first, all right? It's always the poorest to get hit first. So the poorest people in the world, who were mostly, which government were mostly in debt in dollar, they started selling their currency to buy a little bit of dollars, just to make sure that if they if their country were about to bankrupt, then at least they'll still have dollar that will hold the values, all right? So people have been saving assets in dollar just because, just in case, dollar is always safer. That's the big problem. I told you, I think this era is the last thing, it's the last time it's going to work. I think the safe asset dollar is probably the last time in history. I stand it for this. I've been saying this for probably a couple years now. Yeah, I think the dollar era, the dollar as international currency era is ending. That doesn't mean it's an instant switch. It's more like it's going to deteriorate first and then gets worse, and then probably the IMF will start pulling another currency to replace international transactions. That doesn't mean that tomorrow we'll destroy immediately the entire amount of US dollar debt all around the world. those debt will probably be paid. It's just that there will be no longer new debt in dollar, which means the dollar economical sizing will start to shrink, all right, instead of growing forever, which means it's a huge problem because when you are so much in debt, you need new debt to sustain the previous debt and whatever, and the permanent inflation system. So regarding the dollar, like I told you, I don't think the end of the world is down the corner. I think just a readjustment is down the corner. The readjustment is at least 10 to 15% drop in dollar valuations and also in dollar itself. So just the money that people has been accumulating in there that they're probably going to ask for afterwards, all right? Because at some point they just expect the US to be better and do better than anywhere else in the globe. Problem is, if Wall Street ends up being just like everyone else, then that means we brace for the best and we'll have to worsen the expectations, which means it will be more profitable to hold your personal currency rather than having dollars, because dollar will lose grounds and it will just do it with a lagging some way. Though imagine that the world has been doing this right now, all right? The world has been going down as the dollar has been doing this and profiting from other currencies worsening conditions because people were asking for safe dollar. But if people start to understand that the dollar will do this, then this is exactly what happens. That's what I teach you, all right? When we have these structures, remember what I told you about the decorrelations. For those who are long enough listening to me, remember that the decorrelation has a structure because one tends to accumulate the other, but they all join up, but they generally tend to respect some Fibonacci. So it means in here, dollar will lose, all right? It will lose less than what the previous ones lost, but these ones will have to catch up on anyway. So it means that for a little while, the best choice you could have done is that in here, moving part of your money toward dollar, but now you really need to think about doing the opposite, catching up on your own currencies instead of dollar, which means this is the curve we'll have with the currencies, right? So now you need to figure out which currencies have been going up in the dollar. I've been moving into dollar more than any others. So these are the trade I'll start doing. Not right now because I need to have the euro dollar to reverse first and most likely the DXY to reverse. But these are the trades I'll be doing afterwards. Which are the countries that have been storing a lot of value into dollar because people were fearing for their currency? Yeah, I think the Turkish lira is one of them. China will probably the biggest ever in here, and USD MXN. Just as I think the ROB is not necessarily going to be the most impacted, but I think all those things, all right, the worst weak currencies versus dollars, I think there are going to be some trades to deal with them. Not right now, all right? I need early signals, but the fact that, as you can see, not all of them, but most of them are showing signs of potential reversals is good, because that's exactly what I'm going to try to exploit in the future. All right, like we've been moving up. I think there is quite a retracement to show up. That's probably what's going to drive USD valuation down. The worst currency asking out, just as like the big currencies showing that they're not that bad. And most likely that US and Europe, they're probably on the same shits. It's just like we expected this shit never to show up in the US. It actually probably will, which means we're already in shit in the Europe. You'll come joining our shit, which means we're going to have to make it even some way. That's what I think. All right. Anyway, so that's for the currency markets. And just to make it a final, I'm still hugely concerned about all those valuations, the Teslas, the Apples, the Microsoft. They start falling, and just like I said, if they confirm support breakdowns, then there will be no change in motion. At the moment we get out of this squeeze is the end of the story. Right. And like I told you, squeezes in bubbles are generally not a good sign. We can squeeze the market when the volatile area is there, but the problem is we had this volatile area last year, so I think this volatile area is less likely going to put some higher grounds. I think we're most likely going to start losing ground, and when we start doing it, there will be no turning back. Or at least, like I said, there's never 100% chances for something to happen. It's just that the odds for these types of markets to reverse positive after start losing grounds are very close to zero. They're never zero, but very, very few chances, which means we can expose ourselves to those markets. Still a little bit too early, so like I said, don't take it for granted. We've got early signs of losing ground, but we really need to confirm that. And the NFP is going to be probably a game changer. It's still goddamn hard to say it, all right? So just like I said earlier regarding Wall Street valuations, I think NFP is in here for us. Is in here is the important thing, but I don't nearly think we're going to hold to yesterday's low. Market will probably start to work out this area, but just like I said, I think the workable area is in here when we got the moving averages, and I think this is where we're going to work out. So like I said the other day, I think I still stand for it. Multiple options for me. It's hard to say if we're going to go for this one, but it feels like either we go for a range in here after going straight line in this area, which means we're going to accelerate in here, which will be fucking worse. Remember that to me, the structure I'm targeting right now is this one. Remember, oh, damn it. Remember, first wave, second wave, equally sized, overlapped one to another, all right? Means we have the fifth wave extended in here, and I think we just made wave one. So the question is, are we going to have a shorter wave two? And in that perspective, this is what we're going to have, all right? Ending diagonal. And in that perspective, I think we can buy this dip just for a short-term pullback to retrace in the range. Option number two, and we're probably going to retrace deeply in the range, probably closer to 29.70. So deep pullback in here, which means I'll probably profit take 25% at least in here just to have some spare cash to sell again. But anyway, that's what I'm going to be doing. If that's what's coming, and if we make a shorter wave too, then yeah, I'll probably short-term my expectation and rise the profit taking I'll do in here. But that's still speculative because we could be just doing a first wave one, in which this is wave one. We do wave two, we do even bigger wave three, and wave five. That's an option. And don't forget about it. The problem is when we get wave five extended, we also tend to be doing something like that. An extended wave five, right? So don't underestimate the problems, right? The thing is that what we've just triggered in here could be pretty fucking bad, and people tend to ignore it. I wish you don't, because once again, I've been looking for this bearish movement for a little while. Would be pretty fucking stupid to start reversing bullish now. That's the worst case scenario. Remember, I told you about this for a long time. If you had a bearish bias on this beautiful, ugly range, yeah, beautiful, ugly doesn't mean anything, but yeah, this range has been taking and lasting for a long time. I already told you, I don't nearly give a shit about what you think. Just have a plan. Have a choice. You make your choice of whatever is going to happen out of this range. You need to be either bullish or bearish. I personally have chosen bearish for obvious reasons. All I've been explaining earlier, shit tons of risk. I already have exit signals. So I think this market is just topping up, period. That's what I think, but I've got technicals suggesting it as well. You might like it, not like it. I don't nearly care. It's what I will do. And as long as I haven't been proven wrong, I'll do it. But I'm not going to do it blindly and stubbornly. I'm just doing it because I have information suggesting it. And those informations also suggest that if I get invalidated, I'll just get the fuck out. I'm not going to hold on to bearish entries. There is a timing for me to play this game. And you really need to understand that. You really need to have that as well. But you must have a plan. You must have a bias. Bullish or bearish. You might think the economy will recover or the economy will probably not. Either way, trade according to what you think. But if you think the market is bullish, I don't think this is where you want to buy. If you want to buy it here. All right? Support prices in this area. This is where the market is somehow a little bit interesting to at least try something. All right? That being said, so what I was trying to highlight today is that, yes, what we're dealing with right now is midterm reversals. The entire market is fucked up onto every of the shorter time frame because the big time frames is losing ground. We don't know where to go in the big picture. The problem is if we start worsening in here, meaning if the weekly momentum gets to break this low, you know what the hell's going to happen next. The next area to target is this oversold market. And as we have reversing top, we're probably going to go lower than that, which means weekly oversold territory. When we oversell weekly, generally means we're heading into recession type territory. I mean, not necessarily economical recession. I'm talking about price, asset pricing recession. I mean, dropping more than 20%. So getting into the 30% territory. That's what I think, right? We're going oversold, where this is where we're going. So that's the plan I'm trading. I've never said this will obviously have to happen. All I'm saying is that this is what I've chosen. And you need to have that choice as well. All right. For the French guys, I gone a little bit further today, pulling you into what I will do if this thing actually triggers, which is you must always have one step ahead. Be aware of if this thing happened, this is what you're going to be doing. And I've been clear, right? I've got my plan. Until now, I'm moving in motion for asset allocation and portfolio, global midterm to long-term portfolio allocation, in which right now I'm mostly cashed out or very liquid asset that can hardly lose grounds. I do have gold and I do have cash. I do have cash in multiple currencies, so I'm just holding value right now. All right, I'm not holding growth. I'm holding value, waiting to get potential growth later on. So I'm waiting for prices to be attractive enough to buy. That's the thing I'm doing right now. Though in between, as I still have to do something to get to make money, I'll short sell. I short sell the highest valuations because this is where there's the highest potential profits. But this is only because there is also crazy fucking high risk of short selling. This is the reason why. It's always very risky to short sell. So why would I short sell assets that can be easily sold? No, I'm short selling assets that can have the highest rewarding potential, the Apples, the Microsoft, all right? High level of risk taking means I need to have high rewards on those assets as well, all right? Just limiting the risk, that simple as that. All right, Apple has been taking me a couple years to find the market top. I don't know if this one's going to be the good one, and if it isn't, I'll still try it out later on. I'll find it anywhere, and when I'll find it, it will obviously drop sharply. And I already caught the first one last year, so I think this one is just a pullback, right? But we'll see. Maybe I'm wrong, but I think I'm right. Anyway, so we'll see about that. But if the market starts falling, you must be prepared for the next step. It means not right now, but you need to have a plan. And these plans, the goal for today's explanation is that the larger the time frame, the stronger your convictions must be. And in order to have strong convictions, try to avoid not being biased. You always have a bias, remember, anyway, but make sure those biases are not impacting. So how do you do this in a midterm to long-term perspective? You really need to listen a lot of stuff, and not just out of the same sources. You need to listen a lot of multiple sources to have not a clear sight, because you're never going to be clear sighting anything. You're always going to be having a little tainted bias somewhere else. So the thing is that you need to make a choice, and you need to make a choice strong enough that no one can make you change that choice for at least 2 to 5 years, because that's the time scale we're talking about. For midterm to long-term investments, you're going to have to buy and hold stuff and hold the fucking value for at least 2 to 10 years, or at least that's the average scale of those trades. So now think about, you must be thinking about something, and no one on earth can make you change your mind for at least 2 years. That's really a high level of confidence. And you must not be overconfident. So you just need to have a decent level of confidence, solid enough for you not to change your mind. And to let no one let you change your mind. All right? That's important. The only way you can change your mind is if someone is not subjectively taking all the arguments, all your bricks, one by one, and breaking them down with rational argumentation. And that shouldn't be the case. If you've been well informed, then normally, even if part of your information were biased or truncated, not true, or even fake news, all right? Some of the news we get today is totally fake, but normally it's not possible that all of the news, all of the informations you got were false, all right? Which means even if someone shows you that what you've been taught was partly false, then normally the rest of it must remain true. And even if someone is trying to change your mind, you should still keep them that way. I'll give you an explanation, all right? I just made it for the French guys. I don't have time to do it with you all along. But here is how I'll orientate my personal portfolio afterwards. So if we get to have this economic slowdown, that's what I would call it. I don't think recession type of trades, a recession type of economy. I don't think economies are going to go recession, or just getting close to it, or just a tiny bit of recession, but not the deep, long recession 2008 type of. I think it's more like, yeah, sharp, like a fallback from 2008. Like we try, we would recover, and we actually don't. People fear that we go back to 2008 as we probably won't. So you need to be ready. That's the reason why I have mostly my assets in cash ready to invest at any given time, because that I think that's the thing I need to do. For many reasons. It's not just a feeling, it's because of structures. Like I said, we're probably going to have drops in price because people have been picking up some risks with stupid prices, and we can rapidly make these guys panic. And as they panic, they'll short sell. They sell rapidly. So you need to be have cash available fast, because those opportunities they're probably not going to last long. The problem is that nowadays, if you have a look at all the banking system and how they work, they are a shit crazy fucking ton pile of cash. And that's the problem. If the banking sector is holding cash, generally means they're waiting for opportunities. And that's not good. Because when they do, means they either wait for opportunities or wait for prices to drop. But let's say that if that's the second option, then they'll be ready to buy. And you must be ready as well, because when the smart money buys out tiny traders' losses, they generally don't make it well. We generally don't last long there. All right, it's like the 1987 kind of trade. We go down very sharply, and then the market recovers instantly afterwards. Like there is no risk management on the bottom. Like we get there, volatility drops, and then market recovers. That's the kind of thing I think we might expect. So available cash immediately to avoid the shit, because people will fear for the shit to last long, and I think it won't. But there is also another problem. That's the scenario number 2. First alteration for the scenario. First case, all right, we go worst case scenario, people panic, they sell, we buy them out, and things are actually not that bad. We hold to between 0 and 2% growth globally in the world. Like we don't grow, all right, that's it. We go stagflation and stuff like that. Very low inflation, very low growth. So yeah, we could have those things for a few years. I think that's what that's what I would bet on. All right, lower growth elsewhere, everywhere in the world. Globally, economic slowdown. Like yeah, it would feel like a depression, but just not. I think we've been over optimistic after 2008 recovery, as the economy hasn't recovered. So I think we're just going back to reality, to growth better later. Second option, and which is another problem, is I don't bet on this one, but I assess this option as well. Because always remember that if you have just one plan, and if you think that plan is obviously going to work, means you're not trading, and you're definitely not investing well neither. So my invalidation plan for this type of scenario is if this potential, call it, I think it's more likely going to be a financial crisis more than an economical crisis. But if the economical crisis starts to get in motion, to set in motion, in which people lose their job, they get depressed, they stop spending and stuff like that, we might have a bigger issue. Because if the governments are just trying to save the banks, which they eventually will try to do, there's going to be a huge problem, because this time it's not going to work. We can't play the 2008 again. People still hardly remind what happened. They're not going to save the banks this time. So the problem is, if we get recession, there can be a political shift. And if we do have that political shift, then that's another problem, and another real tough problem, because these things can turn things way more complicated, which means investment can be halted for quite a significant amount of time. So as next year, if we do, or even not next year, people tend to believe 2020 is going to be a huge problem. I believe that we can have problem out of 2019 already. Like I think the worst is going to be for next year's, for next year. Like the huge price drop could be in 2020, but we got to prepare for it anyway. And anyway, so if we get into switching into more deeper problems, like political problems going along the way, in which simply people asking for political changing And if they do, I mean, striking on the streets, whatever, global movement like the students showing up on the street and saying, fuck, we don't want those rich getting richer, we don't want those tax cuts, we don't want those corporations driving the world, we want green revolution or whatever. I think that's mostly what this thing is going to be about, because it's always like that. When people are getting dystopian, like that's exactly the kind of future we're forecasting right now. The rich are forecasting that they're going to basically hide into big, beautiful, robot-like castle in which they can hide from the poor assholes out in the world, though they can live with their robots and their wealth, and the rest of the world can be poor and badly fed, but no worries, we're in a castle, no one can hide us, and if they put too much shit on us, we'll take our beautiful shuttles and go to Mars. So that's what they think, all right? That's a huge, huge problem, all right? So when these things happen, means the, let's call it the upper class, or let's call it the wealthier person on earth, have a huge mind gap between them and the rest of the world. And the problem is they think they will stay like that forever. Anytime it's been happening in history, it rarely ended up well. So generally it's been causing those political changings. And when I'm talking about political changing, like I told you earlier to study what happened in Great Britain back in those days, then you should really think about that, because yeah, this is the problem that can happen as well, in which the economical problem starts to get political. And if they end up being political, this is where the problem will show up, because political problems will delay investment. So that's the reason why you need to spread those investments. You don't buy just the 5 corporations, all right, or you don't buy yourself into, all right, I'm talking about buying shares and stuff like that. I'm talking about buying at least 50, just because you can hardly say, and you buy into multiple areas. Like I personally will put a little bit in India, I think just a really, really a little bit, because I don't know India, I don't know these countries, I've never been there, or very shortly, so I just passed by actually. So anyway, I'm not investing into countries I don't know, so I'll go China again probably next year. I'm gonna have to learn Chinese. That's a fucking complex language. But anyway, so I'm probably gonna split between China and US, obviously, because I don't think this trade war is gonna stop. I think this is the kind of trade war that's gonna last real longer than people expect it to be. I think what we just started is never going to end. It might change the shape, all right? Like the tariffs might eventually be removed, but that doesn't mean that China will be a friend with the US anymore. It's not even possible. So yes, this war, economical war, is going to keep on going. And if it gets political, then it's going to get even more global. And the problem with political wars is that we better hope it's not going to go down military war. I don't think it's going to happen, but that's also a possibility, all right? That would be the worst, the darkest possible scenario, that we get economical problems, that we get financial problems to trigger economic problems, to trigger political problems, to eventually trigger military problems. That will be like a chain of awfulness to show up. I don't nearly think we're going to go halfway with that chain. Like I said, I think the financial problems barely, and I think they can hardly be avoided. Is this going to trigger economic problem? I would say on the surface, yes, all right. But is this necessarily going to crack the iceberg? I don't nearly think that's the actual choice. So is there still investment to make in the economy? I think yes. But this investment must be done smartly, very spread it out all across the globe to avoid any areas of tensions. They must be spread across multiple sectors, because we need to find out what could be the next cycle growth sector. And if people bet on, oh great, it's going to be technology, no fucking way, it's generally not the case. So I would say generally tend to invest in what people believe in. And what do you think? Remember, just all right, let's cut the crap. So now just try to think about how people were thinking in 2006 and 2007 and stuff like that. All right, people were just hoping and bracing for informatic and no wait, that's not the right word, from computer and technologies to develop. All right, remember that back in 2008 we were just starting to have smartphones, so that's exactly it. People wanted more of this, wanted more of those sensitive technologies that we can bring with us. That's what people wanted, all right? We wanted to increase technological stuff. So that's exactly what's been creating growth over the next cycle. This cycle has been all about it, putting some computers and smart computers into our pockets, smartphones, all right? Having bigger screens with better technologies, with stuff like that. Now, what do we want? Now think rationally what people want right now. They want two things. They want green energy and they want robots. That's exactly the stuffs in which I think it's necessary to invest. But don't think dumb, all right? Just don't say robots. When I think robot, I think about this company. That's not how we're gonna do. That's not how I'll do personally. What I think is the next step. Who's going to supply those companies, all right? Though I'm obviously going to buy the big robot names and stuff like that. I'm probably going to buy a couple of them. Like I said, think about 50 companies investment. You cannot just invest into 5 to 10 companies, all right? Like buying 2 robot companies and buying 2 energy companies, all right? Now, it's way more complicated than that. You need to look forward for who's going to supply those guys, because that's where you can make the money. Right? And this is where you can spread the risk, just in case you ended up being wrong. All right? So think about, first layer is the big names. Second layer is who's going to supply the big names. And the fourth layer is who can be going absolutely on the wrong way of what you expect. I'm going to invest into companies I absolutely don't trust. I absolutely don't think they'll create growth, but I'll invest them in anyway, because you never know if you're going to be right or wrong. So think about 50, all right. Top 5 is the big names, the one you bet on, but you don't put that much money. These are the ones that can make 5 to 6 times or 10 to 20 times the rewards at the end of the economic cycle if you pick the right one, all right. The second one, the suppliers, you generally put 20 to 25 investments in there, which still leaves you with an average 10 to 20 investments remaining to make afterwards into different sectors like Medicare or healthcare. I think this is going to be one of the topics I will probably try to get them to. Financial services, not banks. I'm talking about financial services. All right. Eventually, cryptocurrencies could be along the way here as well. All right. Oh, and by the way, I forgot about this. So I'm just going to terminate with cryptocurrencies just because I've done it for the French. So at least you've got the same content. So here's what I'm going to be doing with cryptos. I think that we're going there. Just giving you this tip. All right. So just going to open up this thing. All right, let's remove the drawing. So I have a rule. This is something I share with you guys. When I see something like that, I've got range signals. We're lacking of momentum, but still there is a contradiction. All right, we've made new lows, not necessarily with the candle closes. So there's no divergence. But in here, I was hesitating. Like I told you, I need more information. Now we've been holding on those valuations for long enough, so I think we can, with a limited amount of risk taking, think about this area to hold on. So that means catching a pullback. There is a rule. I can explain you what this rule is related to. At least it's going to be part of the actual possible reason for why. But generally, when we do this, we tend to make new low for 7 days, for 7 bars, for simple reasons. Sorry. So yeah, the thing is about fractals. So a fractal is generally used out of 7 periods. So I hope you do know what fractals is. It's just making new highs and new lows for that number of periods. So making new highs and new lows for 7 bars is what the market is very likely going to do. So in order to create another fractal in here, we would like to make a new high for 7 days. So I think in here is not yet been done. 1, 2, 3, 4, 5, 6. No, this one hasn't been doing it yet. So yeah, we now have a fractal in here. Sorry about that. So we do, no, 7 days, not yet. 1, 2, 3, 4, 5, 6, just 6 bars, so one day off. So normally now we need to know another set of 7 bars in here, probably making just a new high in here in between. So what I expect now is probably just a little pop and then a drawdown to get to create a new low for 7 bars. And that's that low for 7 bars I'm trying to catch. So I think very likely this is that type of lows that we're going to have to highlight, depending on how long it takes. But I think it's over the weekend that's probably very likely going to happen. So what I would like now is the market to first pop up above 26. Sorry, I'm Ripple. Fuck that. I'm talking about Ethereum, still my favorite ones. Alright, so in here we have the 7-day bar. Alright, so we've done it. That's the 7-day. Alright, that's great. So now what I want is make a new low. Alright, so I want a new low to come in here for 7 days. So that's getting below $164. So just dipping a toe below those levels is what I want. Getting in there just a bit to create the new fractal and get to buy that shit. Still very risky. I remind you that the area I favor was probably much closer to 150 and 40. But it's just I'm going to remove part of the orders I've been of the money I put it in that pending order, and probably half of it, and probably try to buy this area. It's a buy and hold, all right? So remember that anyway in here, the money I put in, I'm never going to put it out until this thing goes to 0. Though no leverage, the position sizing goes accordingly. I'll risk manage this trade if we ever go down to 240.50 area, because I think that's where we're going to go. Actually, I think the plan is just, we plan to go there any fucking way, but as we gone in here, there were probably too much speculators buying cryptocurrencies with leverage, though I probably think the market makers have been deciding to wreck them out simply because too much buyers, it just takes us a few millions to bring them down. So let's use the millions, we break them down, we take their money, and though we can buy with better prices. I think that's what's been in motion. But I think going in here is what's very likely going to come. So I think we're going the next there, and just this was just too much people buying, though we fuck them up and then we buy. All right, I think that's what happened. So yes, I think it's about time to buy and hold the Ethereum, because I was fearing the market in here to lose ground significantly. That's not what I see. What I see in here is just a burst in volume, and then no volatility. If we kept on going down, I would really have been at least doubtful. So doubtful enough not to do anything. Now, what I can see is that out of this price drop, we never managed to go lower. We haven't been going anywhere lower than level. So I think, anyway, we just got there for volatile purposes. I think it's just a volatility burst in here. So after volatility, I think low volatility is going to come. So I clearly don't think that what's going to come next is this. All right, like, bam. No, what I think is going to come next is, like I said, I told you, low, high, high, and eventually this. So more like a rounding bottom structure. Something's going to take a little bit longer than you think to get there. Though I think risk managing in here seems absolutely viable, and I think the next way to get to 540 and $530 area is probably going to take longer than you think. Right, so I think buying in here is normal. I think this is just a little bit of too much speculation, but the fact that there is no follow through still tends to lead me to believe this. Though I'm not speculatively buying stupidly. All right, I'm going to need signals. All right, to get into buying this. And I'm going to need confirmations. When I'll get to confirm, this is where I'll tell you, all right, my buy and hold has been triggered and stuff like that. So I'm looking at those prices, and I'm certainly more than anything else looking at how prices will react in those areas. I'm just not going to buy at 166 just out of nothing, all right? I'm going to need strong signals suggesting what I just told you, that we just get a tiny short-term pullback is what I want to. So technically speaking, what is the kind of signals I'm going to look forward for? First of all, a fucking context, so I need to highlight a time frame that is going to be suitable for this. I think 1 hour is going to be the good one. Give me just a second for it to plot. Hey, 1 hour is still hesitating, so 1 hour is certainly not going to make it. Damn it. Damn it. So I wish we could have reversed the 1 hour chart. Maybe it hasn't been. Damn it, that's not possible. How How low did we go in here? Man, we've dropped 20%. Something's wrong with the indicator calculation in here. I know the algorithms, we shouldn't have dropping just like that, just that. So we've been dropping $46. No, something's wrong. Something's wrong. That's not possible. I need to review the indicator calculations. The resistance context must be lower than that. So there's an issue in here. I'll work it out with the next update as well. But in here, something's wrong, all right? Normally, we should have a resistance support context reversed. We should have both of them heading into this way. Like in here, we should have reversed. So something is wrong in here. These things should probably be lower, and I bet we should have crossed them or nearly be doing it. And normally, we should have a support context in there. So it will be buying below this support context. So I would say this area, though, as I told you, indicators have a calculation issue in here. Believe me, because I know indicators are not magical, right? They're here to represent what I think. So in here we had a reversal. Like I told you, if we wanted to maintain those channels to lower valuations, we would have had to go way, 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 way lower. We've had to resist in here and make new lows. So as we failed to make new lows, I think we should have changed this channel sizing and direction as well, probably. So yeah, something isn't going right in here. I'll investigate and eventually update, but something doesn't play according to the rules I set in the indicator. Anyway, I'm going to leave you guys with that, so I'm going to back check that stuff and eventually put it into the next update. So in the meantime, forecast, this area is the one I care about, most likely below this 164, and look for either early bullish signals like hidden divergence or bullish structures, or oversold territory, all right? Like all the blue signals would be what I'm looking forward for, all right? To show up that the market is trying to build a breakup in this area, like not necessarily the end of the world type of breakouts, but the type of breakouts to lead us to 240, all right? If nothing, then nothing, all right? No signals, no trade. As always, nothing is ever going to happen just like you think, all right? Make sure that things happen the way you expect them to be when you want to expose yourself to the market, especially when it goes to making a little buy and hold entry, all right? That's it. Bye, guys. Have a good weekend. If I take this trade, I'll eventually step on by Discord to tell you. Otherwise, I'll see you guys again on Monday.